Hello and welcome to the Moving Market Podcast. I'm J.R. Gondeck, and as always, joined by David Sokolovsky. David, let's jump into notable market events and activity in January and kind of look ahead to what we see February and beyond.
Sure. Thanks, Jared. So 2024 began in the way that I think many expected. Some of the higher, price to equity companies with very high valuation had, strong performance in 2023, but gave back a little bit of ground in the first, month of 2024. In the first day or so of February, we saw, more activity in the growth side of things. But if you kind of parse the different categories, the S&P 500 was up about 1.5% for the month. The equal weighted index, slightly down. And then if you look at it, a lot of it was driven by tech results where the performance and the outcome was better than expected. And the downward trajectory in any of the stocks that had it was really driven by the lower outlooks. And then if you look across the other categories, high dividend paying stocks, the SPYD, which is the high dividend paying stock index, was down for the month. And then the bond index was flat to down as well. So the only place that you saw, really any kind of positive performance was in the S&P 500.
And David, when you look at the S&P 500, to your point, 70 to 80% of that return was a handful of companies. Again, a little bit similar to the overall results of 2023. Now the challenge as we look ahead, post big tech earnings, a little bit of dispersion between some of those. A number look like there's still a fair amount of top line growth ahead, but then you kind of get back to that chicken and egg. Did the valuation and stock performance already look into or kind of price in a lot of that growth ahead, or is there more to go? And that's what I think the challenge facing a lot of investors. What do? Do you rebalance, or do you go with the trend of concentrating your portfolio in these few names to look for that growth ahead? And again, that continues to be a lot of the challenge facing investors. And now when you look into the other big thing to watch, this first quarter is the Fed, right? And the Fed meeting, as we kind of expected, the Fed's goal is to pour cold water on market expectations for rate cuts. And you saw that, in the weeks leading up to the Fed, you saw that in the Fed meeting, you saw that with Jerome Powell going on 60 Minutes, which again, we haven't seen very much of, the last number of years of kind of going to mainstream media to talk about Fed policy and interest rates overall. But again, you can see the challenge. The market was expecting 6 rate cuts. The Fed really only wants to give 3 or less. And then the timing around that is going to be interesting to watch. So again, that was not a big surprise from the Fed to our view. But again, I think they're trying to continue to talk to investors and everyone out there that they do not want to cut interest rates as much as the market wants.
Yeah, Jared, I think on the interest rate discussion, the Federal Reserve is really looking at a couple different items, right? One is, continued inflation, and by many measures, that continues to improve. We'll see what the reading looks like for the month of January here shortly. But, we see inflation continuing to get better. There was a little bit of a jump in headline number in December, but the trajectory has been down. If you look at the PCE, which is a preferred metric of the Federal Reserve, it's been under 2% now for the last 6 months, and just around 1.5% for the last 3 months. So inflation is getting better. I think the Federal Reserve is just very, very concerned about the potential for a bouncing back. And the other side of that conversation is the labor, right? And you're seeing that labor is, potentially making a rebound or continuing to remain strong, depending on how you look at it. But that's really the balance that they're trying to strike, is how do they keep, labor at maximum employment? And we're very much ahead of that right now with a 3.7% unemployment rate. We're significantly ahead of what full employment looks like at 5%. And then again, just making sure that as a consumer-driven economy, we continue to have that demand from a strong, robust labor market, and not getting away with, not letting inflation get away from them.
Well, David, when you look at the consumer, the momentum is still building positively for consumers overall. As you said, inflation's heading down. The labor market remains very resilient. Wage inflation remains very strong at or above 4%. You continue to have the wealth effect benefiting consumers with home equity balances at record highs, 401k retirement balances high. So future spending, the outlook of consumers should remain strong, overall. The job market, I think, is going to be a continued debate. What's telling the real story? Is it Friday's jobs number showing 300,000+ job growth? Or is it the ADP report on Wednesday that showed a little over 100,000? And again, just reading the tea leaves of what we've seen so far from companies, fourth quarter results, you don't see too many announcements of a lot of hiring plans. You don't see a lot of layoffs either. You see a few hundred jobs here, a few thousand jobs there within company results. So that the labor market continues to look, and the data supports a leveling off despite the Friday job number strength. But again, the challenge we see with the Fed is they can easily use that strong jobs number to kind of shrink the number of rate cuts from the market. Overall, our challenge is the Fed looking a little bit like they did in September of last year with third quarter GDP, that you're focused on something that maybe isn't as strong as the overall results. We'll see. And again, the expectation now in the market is there's no March rate cut. And the Fed has kind of done their job as they see it, which is to kind of talk expectations out. But again, take it a step back from whether the labor market is really strong or leveling off. The consumers are still in good position. So the economy still has very good momentum, looking to now and throughout 2024.
Sure. I think one of the things that's interesting, with inflation being a key concern is, and we've talked about this a number of times, in our discussions on these recordings as well, is, one of the biggest areas of inflation has been on the food sector in terms of, gouging on some of those products. We've talked about how now there's been additional pressure, and that's going to start to mount. You've seen it from the president, you've seen it from senators and others who are starting to pressure food companies. You've seen that pressure also come in the way of, a distributor in Europe kind of reducing some of the products that they sell because of what they see as very, very high inflation by some of these companies. And so ultimately that kind of food inflation could ultimately work its way out of the system as well, as there's more focus on that, and bring things down a little bit. The other area of inflation, again, remains shelter, right? And so if you look at where shelter is, and if you look at the data, such a large portion of consumer debt is tied to shelter, and that is, fixed number overall. And so unless there's a strong desire, need for somebody to move, they have the flexibility to avoid some of that inflation. So if you're living in your house and you're not, let's say, moving anywhere this year, you have a 30-year fixed mortgage, which represents the majority of debt out there. That inflation is starting to, have less and less of an impact on you because, again, your one largest single item is your home, and that's pretty much fixed. So consumers do have, the benefit from that perspective. And if inflation continues to improve, that paves the way for the Fed to ultimately get to the same, number of rate cuts that they're looking to do. Because the Fed has indicated that they want to do 3 rate cuts this year. One month this year is done, right? So sometime between February and December is when it's going to happen. It's looking like it's going to be, potentially like a June, September, and December, quarter point rate cut. They did indicate that it does take some time to feel the impacts of those rate cuts, but then they also have a number of rate cuts priced in for next year. And if you look at where the Fed is looking to go over the course of the next 2 to 3 years, you may not know exactly where that is on a given month, but over the course of the next 2 to 3 years, the Fed wants to get down to 2.5% to kind of 3% interest rates. And so we know that trajectory is heading that way. It's just a question of when do we get there, if it's a little bit sooner or a little bit later.
Well, and if you look now, David, let's talk maybe some of the risks in the markets and the economy. And, when you look at the concentration and, maybe overconfidence within the handful of big companies within the indices, they're all great companies, but the valuation on an average of those handful of companies is 50 to 60 times earnings. So to me, there's a lot of losing memory of 2022 of the big losses, because the challenge is, you have a great quarter, what's wrong with a 40 PE or a 30 PE for some of these companies? And it doesn't sound like a big difference, but at some point you could see a big percentage decline and a rebalance into everything else. Because broadly looking at the overall valuation within the market, there's a lot of opportunity out there. It's just that investors have been laser focused on the handful of companies that have done very, very well. And at some point, if the economy strength is continuing to be very broad, there's going to be a lot of opportunity. The other thing we've seen this year is a lot of mergers and acquisitions to start the year. So there's a lot of kind of putting money to work that hasn't happened, which should continue. And the other challenge to look for on the risk side is, will the Fed wait too long to cut interest rates and cause maybe some banking stress, which we saw a little bit in kind of New York and apartment and commercial real estate, maybe for the first time in a year, to see if that has continued challenge, because that's one of the things I think the Fed isn't as focused on. Keeping interest rates in the short term around the 5.5% is continuing to cause some stress on regional banks from having to compete with deposits versus loans. So those are a couple things to watch for. On the other hand, when you look, where do you go the rest of the year with your portfolio? The bond market continues to be a pretty good place if you're looking for income. Interest rates remain steady. And, if you have a lot of concentration and have done very well with your portfolio on kind of the big tech side, there's no reason to sell them all, right? I think our mindset and ultimately with investors will be, let's take 10% profit or 15 or 20% gain and rebalance within the market. And I think as investors stay diversified overall, that'll play very well, over the months and quarters ahead. So with that, we want to thank you for tuning in this month, and we'll touch base on February and beyond.
Thanks.